Hey everyone, my name is Moritz Seibert, CIO of Exponential H Asset Management, and today it is my honor and pleasure to welcome Martin Green to the show for our first interview. Martin works for Cambrian Asset Management, a digital asset crypto trading hedge fund. Martin, how are you?
I'm very well. Pleased to be with you, Mertz.
More than welcome. Maybe let's start at the beginning and go back a little. So you're Martin Green, Cambrian Asset Management, crypto hedge fund. I've said as much. How did you get there? What did you do before? Why crypto? Give us the background story.
Um, I've been in between finance and technology in my career, and several years ago, I was looking for kind of uncorrelated returns that might have a good asymmetry, meaning some limited downside and a lot of upside that was uncorrelated to equities. And I had previously heard of Bitcoin and Ethereum from engineers who I knew, and started to think that maybe that was a good place to allocate some capital. One thing led to another, and I realized I didn't really have a good framework for managing the position or managing risk through the booms and the busts that might have happened and might continue to happen. So one thing led to another. I partnered up with a few other folks. We started Cambrian to do exactly that.
Right. Do you have a trading background? You've mentioned a technical slash quant background, I think, but has your background been in trading, or is this you've now entered the financial space and you're using your skill set and applying it to the markets?
So I have a degree in finance, but for probably 20 years didn't really use it aside from a very short stint at Morgan Stanley in the beginning of my career. Most of my career has been spent building software at technology firms. And then one of them was bought by Google in 2012, and I was lucky enough to take a mid-career break, if you will, from operating in technology, and started to manage my capital and some other folks who I knew in a technology focused hedge fund. And so I did that from 2012 until we started Cambrian.
Right. So Cambrian, I think it's fair to say to, categorize your firm as a quant crypto hedge fund, systematic. Would you say you're
Guilty
fully
as charged.
systematic? Guilty as charged. Fine. I do like that. Is the entire setup systematic? Is everything automated and, coded? Or is it a blend of, obviously you're developing, the algorithms and, this is obviously done by humans.
Yes.
But is everything run in an automated and systematic way?
In short, yes, it is. Everything is data driven. Everything is codified. And it's very intentional that we do that because we think that these markets, because they're so volatile, there's so much uncertainty, you need to be very intentional and explicit about the way in which you manage risk, trade, and of course, we'll get onto this later on. But these markets are like no other, and so they are it's particularly useful to approach things in a very, very systematic way to avoid human errors of judgment. There's maybe one exception to the umbrella concept that everything is automated, and that is you will know this, and many of the listeners will as well. Spot trading can be done completely automated. Options are not as well developed in these markets as they are in traditional markets, and so the system will produce when we use options. The system will produce the direction of when we need to use options to hedge, but currently we execute the option trades over the counter. So that's done by a human. But with that, and that's a small proportion of our trading. We've traded probably $3 billion worth more than $3 billion over the last 3 years, and probably 90% of it has been done fully automated.
Interesting you mentioned the options. I mean, just as an anecdote, in the traditional markets, which I still trade in a systematic type of CTA type of way, I sometimes do use options, and it's systematized in the way that signal is being produced, and it kind of like focuses me on implementing an options trade. But in terms of maturity, in terms of strike selection, that is something that I do manually, just because of
Mm.
it's kind of difficult to do that fully. I mean, it's theoretically possible to do it, but these
Mm-hmm.
markets have wide bid offer spreads. Sometimes the liquidity isn't there, and I'm sure in
Mm-hmm.
crypto, I mean, we can speak about that in more detail if you want. You have Bitcoin and Ethereum option markets, but they
Yeah,
don't go 5 years out.
that's,
It's
oh
like
yeah,
your 12, 18 month, and then some of the other tokens, they are under development. I mean, you can trade
yeah,
volatility in Solana and Avalanche, but it's kind of difficult to trade the 20th token down the
yeah,
cap stack, and
yeah. There's no liquidity in those derivatives markets that down there. Yeah.
exactly right. Okay, so quant-driven firm. There's, we can if we drill down this a little bit more, then you have market making operations, you have exchange arb, you have pattern recognition stat arb, you have trend following, mean reversion. Is there like where would you, if you can say that, where would you put Cambrian? Is it multi-strategy, or are you predominantly focused on one type of systematic strategy that you apply?
Um, it's not. It's an evolution as we compound our R&D and as markets evolve. So we're not ideologues. I think if the genesis for the firm was the observation that there are many um, unique factors around this market that produce positive feedback loops in price. So that creates momentum. And then at some point, those factors degrade, or they get so extreme that they become mean reverting. And so, we'll talk a little bit more about that. But I think 3 plus 4 years ago, when we started researching it, the genesis was that you could both capture the compounding and mitigate the downside risks by focusing on understanding the patterns of momentum and understanding when they break and turn into mean reversion, and understanding, if you can, and this is the hard part, the difference between a signal of momentum and the noise. And so I think 4 years ago, we started with the foundational principle that a modification of a trend following model should work. We've obviously iterated a lot since then, and more recently, so the last year to 18 months, we've added a bunch of mean reverting signals into the mix, and that will continue going forward. But we don't do exchange arb, basis trading, things like that. We are unabashedly trying to understand the patterns in the market, if you will, and expose our capital to risks when the skew and the expected value and is favorable, regardless of whether the market's going up or down. So we're
Right.
long and short.
So you're probably not high frequency trading, and you're not super
We are
short
not.
term. You have a little bit of a longer holding period on these trades. Let's stick with trend following for a little bit longer, because you've mentioned noise, and in traditional financial markets, if you look at the S&P 500, those markets are extremely noisy, and the
Mm-hmm.
trend following signal therefore is very, very weak. So weak that you need to apply it over ideally multiple time frames, many different
Mm-hmm.
markets, to have a
Yeah.
diversified portfolio. And then you also need to be patient in order for that small edge to actually play out, which
Yes,
means
that's right.
that sometimes you can go over a period of years, theoretically, and practically we've seen that as well. After the global
Yes.
financial crisis, trend following type of strategies had a little bit of a rough patch. They didn't
Mm-hmm.
really go down. Not all of them went down, but they were kind of like sideways and choppy, and now they're performing really well again. um, would you say that these type of strategies work in a different way in the crypto markets? Put another way, are the crypto markets as noisy as the traditional markets, and how are they different?
I think they're noisier.
Noisier even. Okay.
They're noisier, yes. So, but the signals are also larger in their magnitude. So it's always about balancing the signal and the noise, as you well know. But these markets are very noisy, I think there are two. We think about the world basically in two. The framework that we apply can be thought of in two ways. One is sort of asset selection and near-term price discovery around assets. And there is a certain amount of signal and a certain amount of momentum and a certain amount of noise around that. So what I mean by that is the conversation as it unfolds over time about whether or not Ethereum and the merge that might be coming up results in a network platform that generates significant value or whether Solana's innovation creates, and that momentum around Solana, the developer adoption, the technology innovation that Solana has, or the lower friction or faster throughput, whether that creates a competitor in smart contracts to Ethereum. And as the market essentially digests information sequentially, that creates both noise and signal. It creates what has been termed information cascades. And this is, in network theory, you see this everywhere, where an investor is looking at that question, let's say that Ethereum versus Solana question, and they're obviously doing some primary research. But in addition, they're looking at what other investors have done as an input to their own decision process, and what other people have done, whether they be developers, et cetera, et cetera. And so as new information comes into the market sequentially, I think you see the price discovery play out, and you see it in sort of either ripples or waves of Ethereum is going to have this characteristic in the distant future, and the market is sort of increasingly discounting that probability of happening more than Solana, for example, relative to just use two. And it doesn't happen all at once. It happens over hours, days, weeks, months. It then goes on pause, and we pick it up again. And so those are the types of patterns that we're seeing in the data, essentially, and trying to discern. And that asset selection price discovery produces its own signals and its own set of noisiness, if you will, because it's very difficult to discern the variables around all of these assets. And we can talk a lot about how these assets are very, very different than traditional equities or commodities, and what that means. So I think that's one. And then we can obviously talk about and we should talk about the market structure in crypto, which is fundamentally different than traditional commodity markets or equities.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.